From London, Fred Goodwin, cross-asset strategist, State Street Global Markets. Fred, good to have you on. Good noon to you.
Good to be here.
You look cross-asset, equities, bonds, currencies, commodities, everything with a derivative. Right now on this Friday, which of those asset markets are you most focused on?
Well, I think everybody across the world is focused on what's going on in Europe, and just about every asset is correlated to what's happening. And of course, this week we've had the 21st of July sort of proposal making its way through the various parliaments. It almost seems obsolete the minute that they pass it.
Right. Well, let's look at the dreaded first chart here, folks. It's something I never look at. The German stock market. And you can see it's somewhat like the U.S. market, but I'm going to suggest different, as we are back to 1998, depending on when you bought, when you sold. Tell me about European equities. What do we need to know about them, Fred? How are they different than United States equities right now?
Well, I'm sure the two indices have different sectoral weights, but you know, the main thing is that the European banks are so under pressure because of the sovereign debt crisis, and really the solvency of the banking system is a huge issue that must be solved. Otherwise, we're going to have a freeze of credit in Europe and potentially a recession here in Europe, as well as knock-on effects to the rest of the world. So the banking sector would be the one sector that's really in focus.
You've lived this with your former employment in London. What is the Goodwin recommendation to recapitalize the banks? Exactly how should that happen?
Well, the thing that has to happen is first thing we have to do is stabilize sovereign spreads. And the way that can be done is to have the ECB take a much broader role, and then use the ESFFs to leverage that up so that you have this this first loss piece of 20%, which they take. That way you can leverage the 440 billion into a much larger number. Then the second thing you have to do is have another look at stress tests, use the EFSF to recapitalize the banking system.
Right.
It's quite possible that it's not large enough, that we probably need to go back once again and renegotiate and then go through the whole process of having it once again sent to the parliaments for approval, because it probably isn't big enough at this stage for that.
And Fred mentioned sovereign spreads there. I've been deficient in this. I haven't looked at them. Here's the Italian-German spread, and you can see the difference in yield between 10-year Italy, 10-year Bund. Here's the good news. And then here's the bad news at 400 basis points, and we come down and you can see the tension into the weekend, this little move upward here. But that still shows that sovereign tension that you've got in Italy. Fred, Switzerland, I call it the greatest distortion. Let's bring up this chart right now. You've seen it many times, folks. Trade-weighted Swiss franc, up we go, 10 deviation move. That's an immense distortion, Fred Goodwin. Are we any better off in a distorted European market? Was there any improvement this week?
Well, the one thing the S&P did was take a very decisive, strong step to stand in the way of the appreciation of their currency on the back of these safe haven flows into a relatively small currency. I think the ECB should take a lesson from the decisiveness and the aggressiveness of the S&P and start buying government bonds in a much more aggressive manner as part of the securities market program. There is some doubt about how aggressive they're going to be.
Right.
They need to come out and say unconditionally we're here to support and drive down yields of the periphery. That's what the ECB must do.
I love this sentence, folks. It brought a tear to my eye. It was a surveillance midday moment. Let's look at this note from Fred Goodwin. There's more jargon in this note. This is just great, Fred. We can see that volatility is inordinately high, skew is extreme, and kurtosis is also very high. Fred, what are you saying there for we mere mortals?
Well, this is a comment on the options market, where we look at the level of implied volatility across a range of European crosses. FX crosses is quite high. And skew is the difference between what people will pay for European puts relative to calls, and that's extremely high because of the fear of the around the Eurozone. And then the kurtosis is what they're willing to pay for out of the money options versus at the money options. And so the combination of high volatility, skew, and a very big smile, as we call it in option land, is really indication of fear in the market.
For TVs, we got a couple of people that watch with tubes. That conversation, their TVs just blew up. Fred, with all that said about kurtosis and skew, is anybody getting any business done? Christine Harper and Jonathan Keene are going to be on later in the hour. Is Wall Street under the desk hiding, or are they actually looking at option theory and saying, let's do business?
Well, I think to a large extent that it's difficult to understand the path that Europe is going to take, and it is so bimodal that until there is some clarity and some confidence that policymakers are coming to grips with what is clearly a very serious situation, the best course of action is just to stand on the sidelines and wait, because it's just too dangerous either way. It's dangerous to be long, and it's dangerous to be short. And so the best course of action is probably to keep your powder dry until the dust settles.
Yeah, very good. Fred Goodwin, thank you so much. Fred Goodwin, State Street Global Markets.